Hi friends, Professor Joe here. I hope you all are doing great. In this video, we are going to cover some more important points that are important to understand before we actually start doing Forex trading. So let us go forward and see what are these important points that you need to understand. Now we have seen what are some basic factors about Forex. Now we will see if you have to buy or sell, what are the options that are available for you and what are the things you have to see before buying and selling a forex pair. Now traders use two methods to enter into a forex trade. One is fundamental analysis and the second is technical analysis. Both these analyses have its own advantages, so there is nothing wrong if you're using fundamental or if you're using technical analysis. Now, normally people say that fundamental analysis is a bit difficult for short-term trading. But when it comes to news, which is a part of fundamental analysis, a lot of traders trade the news. So traders do look at fundamental analysis while trading. But if you see most of the Forex traders, especially the retail traders, they use technical analysis while they want to trade in the Forex market. So as I said, both has its advantages. Whichever you find comfortable, you must use. And if you're getting the results, then you should continue using it. Now, when you talk about fundamental analysis, you are looking at economic indicators like GDP, inflation, interest rates, central bank policy, monetary policy, trade imbalances, consumer and business confidence, political stability. Now, sometimes it is very, very difficult to monitor all these things for a currency. And if you're trading in multiple pairs, then it becomes even more difficult. But there is a website called as Forex Factory Calendar, where you can log in and it keeps giving you updates about important news about every single currency pair, especially the major currency pairs. So if you want to trade Euro USD, USD JPY, USD AUD USD, USD CHF, GBP USD, then in such case, you will get all the updates that you need about fundamental analysis from this particular website. It's a very, very useful website.
So as you can see, this is Forex Factory website. You can see the dates are given, the news timing is given, the currency pair is given, and then the impact is given. You can see there is a white impact, there's a yellow impact, there's a orange impact, and then there's a red impact. Red impact is the one that really brings in a lot of movement in the market. Throughout the week, there are updates that are given, and you can also see that there are some updates which is pending for this particular week. So you can follow this Forex Factory calendar to get updates on whichever currency pairs you want.
Now, fundamental analysis basically will tell you whether a currency is going through a good phase or a bad phase, but it will not show you the comparison between two particular currencies. So, for example, if things are going bad with US dollar, it will show that things are bad with US dollar. But it is not going to show you any comparison between US dollar and euro, or US dollar and AUD dollar, or US dollar and CHF. That comparison is not there. So that you will have to understand reading more news from different websites. All right. Now, if you take an example of Euro USD and you see that, and if things are bad with US dollar, you have to go with a buy, because in this particular scenario, Euro, which is the base currency, is still strong, but the quote currency, that is US dollar, it's losing its value. So when it's losing its value, then to exchange euro against dollar, you have to pay more dollars. So automatically the price in the charts, you will see that it is going up. So you have to go for a buy when you see that between euro and USD, which is a quote currency, is becoming weaker. You need to understand the relationship between both the currencies in the pair. which one is getting weaker, which one is stable, or which one is stronger. Then only you will be able to execute an order. On the other hand, if you're using technical analysis, this is another tool that traders use. And this is one of the most important tool that traders use, wherein you are watching a chart. Okay, you are only watching a chart and you're looking at the movements on the chart. So you're looking at the trends, you are looking at moving averages, you're looking at support and resistance, you're looking at chart patterns, you're looking at candlestick patterns, you're looking at the volumes, whether it is high, whether it is low. At the same time, you're looking at multiple confluences. You're looking at the trend, you are looking at the moving average, you're looking at good support areas, you're looking at good candlestick pattern, or you're looking at a good chart pattern. So you are looking at you are looking at confluence of multiple events that are happening at one particular point, and then you are entering into a buy trade or a sell trade. So you have multiple ways of looking at the chart. So you have fundamental analysis through which you can see what is happening with the currency, and you have technical analysis. So these are two things, and we are going to understand both these things in detail in coming videos. But in today's video, we are going to see how you can enter. What are the options you have to enter in a particular trade? So when you want to enter into a particular trade, these are the multiple options that are available. One is called as market order. Market order is wherever the current market prices, you can either enter the buy or a sell. And the second option is called pending orders. In pending orders, you have four type of options, basically two types. So that is buy limit, sell limit, buy stop, and sell stop. So let us understand each of these options and when you can use these options to enter the market. Now, as a trader, when do you enter into a buy? So for example, if you believe in Euro USD pair, the pair will rise in its value. Okay. It could be because of fundamental reasons or technical reasons. You will place a buy order and the broker will charge you as per the ask price of that particular currency pair. Now, if you think that this particular pair will decrease in its value, then you will enter in a sell trade. But when you are entering in the sell trade, the broker will charge you as per the bid price of that particular currency pair. So in a market order, you are directly entering into a buy or a sell. Remember, I told you that there is something called as a spread in the previous video. So that spread is the difference in the price between ask price and the bid price. So when you go for a buy, the broker will charge you as per the ask price. And when you go for a sell, the broker will charge you as per the bid price. So this is a normal trade that is normally executed in the Forex market. Then we have something called as pending orders. Now, what is a pending order? Pending order is you are not executing your trade at the current market price. You have some assumptions about the market, and based on those assumptions, you are going to put a trade. So let us see what is a buy limit. Now, what is happening in a buy limit? It's the market is trading at a particular price, and you believe that the market is going to retrace back. It's going to come down to a support area, or to a Fibonacci retracement area. Now, what is a Fibonacci retracement? We will be discussing about it. So the trader believes that the price is going to come down. So in this particular drawing, as you can see, the current market price is point number one, and the trader believes that the price is going to come down to point number two. So at point number two, the trader will execute a buy order. So they will keep a pending buy order or a buy limit order where the price is already up and the price is going to come down. When it reaches that level, the buy limit order will get executed. So because the trader believes that there is going to be a retracement, the trader puts a buy limit order. And then when the price goes up, the trade is in profit. The next type of order is sell limit order, exactly the opposite of buy limit. So the market is trading at a particular price and the trader believes that the price will go up to a resistance level. So point number one is the current market price. Point number two is where the trader believes that the price will go up. It can be because of a resistance level. It can be because of Fibonacci levels or a pullback. And from there, the trader believes that the price is going to fall down. So in this case, the trader will place a sell limit at that price, which is above the current market price. And once the market reaches that particular price, the trade will get executed. And once the price comes down, then the trader will be in profit. So these are first type of pending order. Now we look at the second type of pending order. It's called a buy stop. Now what happens in buy stop? Now somebody would say, why would somebody go for a buy stop if the current market price is already at a lower level? You can put a buy order directly over there. Why to wait for a buy stop? So buy stop is basically the trader believes that the current market price is below the buy stop level. But the trader also believes that the price of this particular currency pair or this particular instrument will go up only if it breaks this particular level. This is also called as a breakout trading strategy. So you believe that the price is going to go up only if it breaks this particular resistance. In that case, the trader puts a buy stop order. Here you can see point number one is where the current market price is, and point number two is where the trader places the buy stop. The next type of pending order is exactly opposite, sell stop. Here the trader believes that only if the market price breaks one particular support, then only the price is going to continue in a downward direction. So the current market price is there at point number one, and the support area is point number two, and below point number two is where the trader believes that if the price breaks this level, then only the price is going to go down. Now, there can be multiple reasons. There could be a strong support area over there, and the trader believes that only if this particular support is broken, then only the price will continue down. So, as a trader, you have multiple options. One is you can enter at the current market price, directly market order, buy and sell. The second is pending order. Pending order depending upon your view about the market. Now, whichever trade a trader enters, there is one particular thing which a trader have to be very, very careful about. It's called as risk management. And how a trader can do risk management, the easiest way to do risk management is by using this next technique. It's called a stop loss. So whenever a trader is going for a buy, it can be a normal buy order, it can be a pending buy order. And when the trader is going for a sell order or a pending sell order, the trader should always put a stop loss. Now, this stop loss is an area or it is a price which is away from where the order has been placed. Now, depending upon the strategy, if it's a scalping strategy, the stop loss could be 2 pips or 3 pips. It's a swing strategy, it could be 20 pips, 30 pips, 40 pips. It's a long-term trading, it can be 100 pips, 200 pips. Depending upon the strategy of the trader, this trader can put a stop loss. So stop loss is a very, very important aspect in trading. There is another important aspect in stop loss, which is called as a trailing stop loss. What is trailing stop loss? In stop loss, you're limiting your loss. So, say example, you're limiting your loss to 0.5%, or 1%, or 2%. But in a trailing stop loss, you are also bagging the profit that you have made. So, for example, you can execute a stop loss after putting a trade. Say example, you put a buy trade and then you kept a stop loss. So in this example, we can see you executed a buy trade at point number one, and at point number two, you put your stop loss. Now, if the price goes up, say 20 pips, and you have kept a trailing stop loss of 20 pips, then what happens is once the price goes up by 20 pips, your stop loss will come to break even. Then as it keeps going up, your stop loss also keep trailing at 20 pips. Now it is up to you as a trader how much pips you want to keep for trailing. So some can keep for 10 pips, some can keep for 50 pips. It's up to you. But in trailing stop loss, once the trade start moving in your direction, you are bagging in those profit as the market is going up. And when the market retraces back, wherever your trailing stop loss is there your trade will get executed and a reverse trade is executed and you are exited from the trade. So a trailing stop loss is also another important tool that the trader has in their bag while trading. So when a trader want to enter into a trade, the trader can think about normal buy and a normal sell, which is called as a market order, or a pending order, which is buy stop, buy limit, or sell stop, sell limit. And always remember to put a stop loss. At the same time, if you're confident about your strategy, you can go with a stop loss plus a trailing stop loss. This way you can enhance your trading skills. So that's all in this video where we try to understand how you can execute a trade. That means how many options you have of executing a trade, normal market order and pending orders, and the importance of stop loss and trailing stop loss. But let us first understand the fundamental side of things before we get into the actual trading. I have written a book, Traders You Can Win, but First Learn to Lose. This is basically for fresh Forex traders or fresh traders, I would say. It's available on Amazon. If you're interested, you can buy. All I can say is keep learning, keep growing. Thank you. Namaskar.